Assalamu alaikum everyone. I welcome you all to another lecture for ACCA financial reporting paper. My name is Yasir Yamin and I'll be taking you through towards today's accounting standard class. Now today's accounting standard is one of its own kind. It discusses about the transactions that do not belong to the current accounting period, rather those transactions that actually happen beyond this accounting period, however may be reflected in our current financial statements. I know, you have guessed it, yeah, right. We are going to discuss about IAS 10, which is events after the reporting period. Now, before we even move forward and discuss about the accounting implications that are mentioned in this accounting standard, first we need to understand that what do we call events after the reporting period? What do we mean by this term events after the reporting period? Whenever you see any financial reporting question, whether it be in FR paper or SBR paper or any paper, your first task in each and every question should be to identify whether any transaction, can be labeled as an event after the reporting period. Now the accounting standard specifies what or what type of transaction or what transaction can actually be termed within the scope of IAS 10. If you see here, it's written that events after the reporting period are those events, mind you, are those events either favorable or unfavorable. So during this time, I've seen many people who feel that only those events which are unfavorable due to prudence, that those should be reported in our financial statements, even if they occur beyond our, current accounting period. Actually, that is false. The accounting standard requires us to consider, all events, favorable or unfavorable, that occur between the end of the reporting period and the date when the financial statements are authorized for issue. Now, the one of the most important words that you need to pick here is that when the financial statements are authorized for issue, the financial statements do not need to be published by that point. The financial statements do not need to be approved by the shareholders by that point. The idea is the ending time is the time when financial statements have been authorized normally by the board of directors for issue. Even if they are not issued but they are authorized, this is the ending period for the scope of IAS 10. Now I would like to drill these two lines further by explaining you something. I'll make a scenario which is more relevant to Pakistan, but you can apply this wherever you live based on whatever local gaps that you have. You see, in Pakistan, for example, an accounting year, for example, starts at 1st January. Then it would be ending obviously at 31st December, right? So this is 31st December is end of the reporting period. So if you look at events after the reporting period includes all events that are favorable or unfavorable that occur between the end of the reporting period. So this is the starting point of IAS 10. Here IAS 10 starts. Actually, all other accounting standards close by this time, and IAS 10 starts at this point in time. In Pakistan, for example, if a company ends its accounting year at 31st December, normally what happens is that you have 4 months. If you're a public listed company, you have 4 months to publish your financial statements and conclude your AGM. So for example, for us, the deadline may be 30th April, right? So by 30th April, we need to have our AGM. Now, it's understandable that in certain cases, with specific approvals by the concerned authorities, this date may be expended in extraordinary circumstances, as it happened during COVID times, and as it may happen, during uncertain times due to any uncertain reason. However, the normal period is 4 months, so that this becomes 30th April, right? So you need to conduct your AGM by 30th April. And if you logically work back, according to the local law, a 21-day notice period has to be given to the shareholder, for conducting this AGM. I'll just zoom in a bit. All right. So we come at around, I don't know, it should be 9th or 10th April, you may say, right? So I can call it 9th. And before the 21-day notice period, you need to get your financial statements authorized for issue by the board of directors. So normally, before the AGM notice is sent, the board of directors meeting happens somewhere before the AGM's notice. The board of directors sit down, they query the directors, the CFO, the chief accountant, and the audit committee members ask some questions and so on and so forth. After they are certain that the audit or the external audit findings have been discussed, and the all the current and outlook matters have been discussed, now board of directors authorize the CFO or the person, those who are charged with governance, they authorize the financial statements to be issued to the shareholders with the call of AGM. So in Pakistan, what happens really is that once the accounting year ends, for example, after 31st December, the accountants would start working on their financial statements. By this time, the auditors would come in, and the external audit is being done. To get reasonable assurance of the financial statements, then a draft audit report is given, which has to be presented into the board of directors meeting. By the way, the board of directors meeting happen with the 7-day notice. So the board of directors meet, they check the accounts, they query the accounts, they see the audit findings, they see the audit report, and once they are satisfied, they authorize the financial statements to be issued to the shareholders with the call of an AGM. So uh, coming back to IAS 10, the scope of IAS 10 clarifies that the horizon of IAS 10 is limited to all transactions, first of all, that occur after the reporting period. So all transactions that occur after 31st of December, say 1st January next year, all transactions that occur after the reporting period, I mean, after the end of reporting period, till the time financial statements are authorized. Now all those favorable and unfavorable transactions that happen here, all of these transactions may be known as events after the reporting period. Now it's pretty much understood that if a particular transaction, it may be favorable or unfavorable, if it happens here, within the reporting period, or if it happens beyond the date when financial statements have already been authorized by the board of directors to be issued to shareholders with the AGM's call, all of these transactions are out of the scope of IAS 10. So whenever you are trying to attempt an IAS 10 question, first you should identify that whether if this transaction actually falls within the purview of IAS 10, yes or no. All right. Now, there is one exception that I would like to highlight right here. Now, IAS 10 says that although if a transaction happens post the date when financial statements have already been authorized by the board of directors, these are outside the scope of IAS 10. However, if such a transactions happen right after the financial statements have been authorized, however, they pose a going concern threat. right? So going concern threat means there is a threat that the those who are charged with governance, they see that the business is not going to continue for the foreseeable future. You won't be having a next full year accounting period. So if there is a going concern threat, so going concern threat is always considered as an adjusting event, or I may say it's always considered within the purview of IAS 10, even if it happens beyond the date the financial statements have been authorized. However, if a going concern threat happens, it's always within the purview of IAS 10, right? So you can never forego going concern threats. You can never ignore going concern threats just because they are beyond the date of financial statements being authorized by the board of directors. So it's always relevant. So you need to consider this in mind as well whenever you are looking at the questions. So okay, now you know the purview, you know the scope of IAS 10, but what do we do about this scope? What will happen? Now IAS 10, what IAS 10 basically does is that IAS 10 classifies all events that happens after the end of reporting period till the financial statements being authorized by the board of directors. All events are classified as adjusting event or non-adjusting event. So all transactions that happen during this period, right, this period that we are talking about, either these transactions will be called as adjusting events or non-adjusting events. Adjusting events mean that we will adjust these events in the current financial period. Non-adjusting events mean we will not adjust these events in the current financial period. Now, how will a person know, how will you accountants know that if a particular scenario is an adjusting event or a non-adjusting event? Who will tell you? So IAS 10 basically gives you a certain level of indication, right? So IAS 10 says that if a particular event happens and the happening of such an event provides you evidence that the conditions of this event existed at the reporting date. I'll just repeat myself. IAS 10 says that if you look at the event and you feel that the conditions of this event, the scenario of this event, the background of this event, the belongings of this event actually existed at the reporting date, meaning this transaction happened and some certain level of indication was already there on the reporting date that such a type of event may happen. If you have got a certain indication that conditions have been existing at the end of the reporting period of such an event, then you call it an adjusting event. However, if you see an event that happens during this tenure, however, for such an event no conditions, no indications existed at the end of the reporting date, at the end of the reporting period, then it will be called as a non-adjusting event. Now, for example, many of you, if you're following Pakistan economy nowadays, in 2022, Pakistan had an economic imbalance, right? And post 31st December, the end of the academic or the after the end of calendar year, for example, a certain event can happen which leads to further banning of imports in Pakistan, or maybe some going concern risks may arise, or your customer may go bankrupt after 31st December, but the situations were already known at the end of the reporting period. What I'm trying to say is at 31st December, we already knew the economic conditions were poor, and some of our customers who are heavily dependent upon financing from the banks, post 31st December, they may go bankrupt. And some indications did exist before the end of the reporting period because the economic conditions were worsening from since a while. So the risk was there. Any event which happened after the reporting date, but for which some level of conditions, some level of indications, some level of belongings were there at the end of the reporting period, we should call these events adjusting events. And if there is a certain type of event for which there was no indication, there was no conditions being existed at the reporting period, however they just happened all of a sudden, these type of events are non-adjusting events, and these should be known as non-adjusting events. Now, IAS 10 does not give you a list what events should be known as adjusting events or what events should be known as non-adjusting events. It's not a listing scenario. Rather, IAS 10 gives you the principle and requires you to use your own brain and conclude that what type of events can be called as adjusting events or what can be called as non-adjusting events. However, IAS 10 does give you some examples. I'll just share those examples which are already there in the accounting standard. Look at these. So one type of example that IAS 10 gives you about adjusting events is a settlement of the court case. Now we are also going to see a question like this, but I'll just build up the scenario and that can ultimately support in our upcoming question. For example, for example, you see that at the end of the reporting period, at the end of the reporting date, there was a court case already in process, right? And it is possible that the company may had also provided for for this court case. Some provisioning may have also been done based on the probability and based on the conditions being met under IAS 37. So, for example, at the reporting date, your company knows that a court case is going on, and they may have certainly provided for this court case. And beyond the reporting date, for example, on 10th January, after the hearing concludes, you see that there is a bigger exposure. You lost the case, and there is a bigger exposure of loss now. Now, the hearing actually happened beyond the reporting date on 10th of January, and your reporting date was 31st December. So, this particular hearing event did not happen within the accounting period. Should you recognize a loss within the current year, or should you wait for the next year for this loss to be accounted for? IAS 10 says that this is an example of an adjusting event. Now, this unfavorable event, although happened after the reporting period, but conditions of this type of an event, favorable or unfavorable, existed at the reporting date, and it is clearly evident because you had provided for, based on your own probabilities, you had provided for this court case. So the risk was already there. The conditions already existed at the reporting date. So what IAS 10 says, although this transaction happened after the reporting date, but you should call it an adjusting event and adjust it within the current financial statements. So court case is one of the examples. But just to argue, what if a new court case started post the reporting date? A new court case started. Now what will you do then? According to me, it's a non-adjusting event, because if a new court case started after the reporting date, conditions of that event may have not existed at the reporting date. So there was no indication, there was no there was no hint that such an event could happen, and therefore this type of event, a new court case, actually pertains to the next accounting period. It should be reflected within the next accounting period, right? So whatever accounting says, whatever an accounting standard says, it is based on logic, it is based on common sense. All right. One of the other events that IAS 10 gives an example and says that this is an adjusting event is talking about bankruptcy of a customer. So you know if you have a debtor, if you have a receivable, it has an inherent risk, it has an inherent risk of going default. every customer, every receivable has an inherent risk of going default. Every receivable has a risk of going bad debt, so credit risk is always there. So ISN gives you a particular example and says that if your current customer, your receivable customer goes bankrupt post the reporting date, since your debtor has an inherent risk of going bankrupt, such an event, although it may have happened after the reporting date, but it should be treated as an adjusting event and a bad debt or doubtful debt or whatever the case may be. It should be recognized within the current financial period. It should be called as an adjusting event. Now, one more example that IAS 10 specifically refers to as an adjusting event, and I am a firm believer that this should always be an adjusting event. It's about NRV adjustment, sale of inventories. So all of us have studied in IAS 2 that according to IAS 2, inventories should be recognized at lower of cost or NRV. And according to IAS 2, what is NRV? NRV is estimated selling price minus cost to sell minus cost to complete, right? So the accounting standard requests an accountant that whenever you go on an audit, whenever you are working for your own company, whenever you're looking at a client, just look at their inventory and perform NRV testing. Just look at their inventory, check out what is the estimated selling price, check out what is the cost to sell, check out what is the cost to complete, and then conclude that if an NRV impairment is required or not. Now, based on my own personal experiences, I have worked for almost a decade now. I've had more than a decade actually. I've had good professional experience. In my own personal opinion, it's almost impossible for an accountant to perform NRV testing on any company. For example, you are auditing maybe an engineering company, let's say. Now you go to that company, you look at their inventory and you say that I am going to perform NRV testing. But the point is, how will you perform NRV testing? Where will you as an accountant get the estimated selling price? It's not your industry, you are just an accountant, you're not an engineer that you can actually audit a particular plant and machinery when you go and audit an engineering company. It does not happen like that. You won't know the estimated selling price. You won't know the cost to sell. You won't know the cost to complete. It's practically impossible. All right. So there may be some industry benchmarks that you can refer to, but again, it's pretty much bleak. So what does in reality an accountant does? It actually they perform, you know, they they take a post period sample. What do accountants do? They wait for the inventories that were there on the year end. They wait for them to be sold post the accounting period. And if you see that after the accounting period, let's say this is the reporting date, you see that if a particular piece of inventory or if some inventories were sold after the reporting date and they were sold for a price which is less than cost. So this gives you the indication, this gives accountants and auditors the indication that if a particular sort of inventory was sold after the reporting date, at a value less than cost, then these inventory would have actually been impaired at the reporting date, and therefore this type of event should be treated as an adjusting event and NRV write down should be done at the reporting date. So actually the NRV testing that we are taught about in IAS 2, it is coupled with the scope of IAS 10. IAS 10 allows you to look at the transactions that happened beyond the reporting date, and based on those transactions you actually try and conclude whether NRV testing, NRV write down is required or not on the inventory at the reporting date, right? So it's NRV write down is always an adjusting event, and it's supported by IS2 as well. All right. I already talked about this. I'll just reiterate that going concern threat is always an adjusting event. I just told you that even if it occurs beyond the date when financial statements have been authorized for issue, if it's a going concern threat, your shareholders have the right to be informed, as soon as possible, and going concern threats always become an adjusting event, right? So they are always important. So I just talked about adjusting events and some examples that your accounting standard has given. Now, what about non-adjusting events? Non-adjusting events are those events for which no indications, no conditions, no hints existed at the end of the reporting period, and those are all new cases, new scenarios that happened, right? So few examples could be fair value changes. For example, if on 5th January stock market crashes and the investments that you have, their value goes down. Now this happens on 5th January, before the financial statements have been authorized for issue. So technically this comes within the scope of IAS 10, right? So any transaction that happens from the date of from the end of the reporting period till the financial statements have been authorized for issue, they are within the scope of IAS 10. So this transaction where your investment, the value of your investment crashes down, goes down, this is within the scope of IAS 10. However, it will be a non-adjusting event. Within the scope of IAS 10, it will be a non-adjusting event. Why? Because the crashing of the stock market could not have been possibly known at the reporting date. If it was known that the stock market would crash, everybody would have sold out on 31st December. And this is not how the stock markets work, or any market works. So the market is dynamic. If something happens beyond the reporting date, it reflects the time period which is beyond the reporting date. There could have been no indication or condition at the reporting date. So any fair value changes are never an adjusting event. They are non-adjusting events. They are within the scope of IAS 10. However, they are non-adjusting events. Nothing to be done about them. All right. Proposed dividend. Proposed dividend. Dividends that are actually proposed by the board of directors have to be approved by the shareholders in AGM. Until and unless a dividend has been approved by the shareholders in AGM, it does not become a present obligation of the entity to pay those. And that is why a proposed dividend is never an adjusting event, because no obligations exist unless in the AGM shareholders approve that dividend. So this type of proposed dividend, the purview of it actually goes beyond the date when financial statements have been authorized. The proposed dividend can only be approved in the AGM. So it goes beyond the date financial statements have been authorized. So it is a non-adjusting event always. All right. So it is a non-adjusting event always. What if a major restructuring happens after the reporting date? Now this is fairly obvious. If the restructuring was known within the reporting date, if it was known within the reporting date, restructuring provisions would have been made. Now in that case, if it was already known, if it was evident, if it was, if the conditions had been met within the reporting period, IAS 37 would have already been applied. Now here we are talking about those type of restructurings that actually are planned, announced and implemented after the reporting period. Now, if a restructuring happens after the reporting period, it affects your subsequent periods, not your previous period. And for that reason, restructuring is always taken as a non-adjusting event. Again, your future periods are affected, not necessarily the year before. All right, so it is a non-adjusting event. changes in tax rates or maybe changes in law. This is also a non-adjusting event. You don't know when tax rates are going to change. In Pakistan specifically, you see how many mini budgets come, and the things change in everywhere in the world. Financial packages differ from time to time. Every government does that. So a change in tax rate or law is not an adjusting event. All right. Now, what do we do in case of an adjusting event and a non-adjusting event? What do we do? So the accounting standard specifies the accounting treatment, right? So in case of an adjusting event, the transaction is basically adjusted within the current financial statements. Now, this transaction happened beyond the reporting date. However, since it is an adjusting event, it would be adjusted in the current financial statements that are being prepared to be sent to the shareholders. And disclosures need to be updated accordingly. So this is the accounting treatment of an adjusting event. Update your financial statements, update your disclosures. Now, what about non-adjusting events? Non-adjusting events, as the name goes, no adjustment is required. However, if the case is material, you should disclose. What should you disclose? You should disclose the nature of the event and the financial estimate. If it's possible to have a financial estimate, you should also disclose that. All right. So my friends, with this, we quickly concluded what IAS 10 actually is. Now, remember, I always say practice makes a man perfect, and women even more perfect. All right. So let's have a small practice question of IAS 10. So now let's look at this past paper question. Very interesting question, and we are going to briefly discuss about it. So if you look at this question, your examiner says that Jeffers Company prepares financial statements for the year ended 31st December 20x8. All right, so now you actually know that your accounting period end date, your reporting date, your year end date is 31st December x8. Now this is definitely the starting point of IAS 10. Post 31st December x8, transactions are going to come in the purview of IAS 10. The examiner says the financial statements are expected to be authorized for issue. Remember, the condition is authorized for issue, not published to shareholders. The authorization date is important. So the financial statements are expected to be authorized for issue on 15th March 2009. So our the IAS 10's end scope date is 15th March x9. So all transactions that occur after 31st December x8, but on or before 15th March x9, all of such transactions are within the scope of IAS 10. All right. Your examiner says the following three events have occurred in January x9. Oh, whoa, 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 whoa. These three events occurred in January x9. Now, January x9 means that somewhere here. So, are all of these three events within the purview of IAS 10? The answer is yes, a big yes. All these three events are within the scope of IAS 10. Now, any other event may be termed as an adjusting event or a non-adjusting event. That is the second story. But yes, these are within the scope of IAS 10. That is for sure. Now, the first event, we're talking about a health and safety fine. Your examiner says a health and safety investigation of an incident which occurred in X8. So this incident actually occurred within the reporting period. So indication of the conditions existed at the reporting date. So there was some knowledge about it even at the reporting date. Okay. So a health and safety investigation of an incident which occurred in 20x8 was concluded in January x9. So there was an event which occurred within the reporting period and it was concluded in January X9, resulting in a $1.5 million fine for Jeffers Company. So Jeffers Company has to pay a $1.5 million fine as a result of losing the court case. Now the question is, should this $1.5 million fine be termed as an adjusting event? Absolutely yes, because conditions of this event existed at the end of the reporting period. And this is further evidenced by the fact that if you read further, a provision for $1 million had been recognized in Jeffer Company's financial statements for the year ended 31st December X8. So a provision had already been recognized up to the limit of $1 million. So definitely conditions of this event existed at the end of the reporting period. This fine should be adjusted for within the current financial period because this is an adjusting event. So $1 million had already been provided for, right? So you don't need to do anything about it. But further 0.5 million should be recognized. All right. Further 0.5 million should be recognized. All right. So now let us move on to the second case. Now we need to quickly wrap up this lecture because we cannot prolong it further. Let's go to the scenario number 2. Now your customer ceased trading. We just heard about this sort of example previously, which is also mentioned in the accounting standard itself. If your customer, who is a receivable, actually goes bankrupt after the reporting date, every debtor has an inherent risk of going into default. So if it happens beyond the reporting date, even then it is to be termed as an adjusting event. So it says notice was received on 10th January X9. So it is within the purview of IAS 10 that a customer owing $1.2 million at 31st December, owing $1.2 million. So this means a receivable was there, had ceased trading. It is unlikely that the debt will be recovered in full. So the conditions definitely existed at the end of the reporting period. A bad debt or a doubtful debt should be recognized within current financial year. So it should be recognized within current financial year. All right. So the last case that we are talking about. Now here, just look at it. Here, it says acquisition of a competitor. So the scene is that the acquisition of a competitor was finalized on 10th January X9. I hope my screen is pretty much visible to you. It says that okay, just wait for a second. All right. So it states the acquisition of a customer was finalized on 10th January X9, being the date Jeffer Companies obtained control of the competitor. Negotiation in respect of this acquisition commenced in May X8. Okay. So most of you might be feeling that this should be termed as an adjusting event. However, in my opinion, this should be termed as a non-adjusting event because the control over the competitor actually happened after the reporting date. So we don't understand. We were already in negotiations with the competitor for a potential acquisition within the reporting period. We were actually in negotiation. But you see, the negotiations don't guarantee control. Was a control guaranteed by the end of the reporting period? The answer is no. No control was guaranteed at the end of the reporting period. The conditions, the agreement has only been finalized on 10th of January subsequent year. So no conditions of these, being fulfilled were present by the end of the reporting period. So this should be termed as a non-adjusting event. However, since this is a material event, a disclosure, a proper disclosure regarding nature of the event and the financial aspect, if it's possible, it should be given within the disclosures. However, according to me, this is a non-adjusting event by far. So all right. So with this, we quickly wrap up IAS 10 events after the reporting period. I hope you had good knowledge of this accounting standard with this lecture. We very much quickly wrapped it up. One request that I would like you would that I would like to do from you guys is you know connect with me. I want you guys to connect with me. Here's my number. I'm on Facebook. I'm on WhatsApp. I'm on YouTube. I'm available everywhere. I'm on LinkedIn as well. Just go and search for my name, and you'll get me by this face probably. So just connect with me. I like to connect with you guys. If you need my help regarding this subject or any other subject, if it's possible for me, I'll definitely get back to you. All right. So just contact me and also subscribe. Yeah. All right. Thank you very much. Have a good day.